Let's dive into the Pi Network, a digital currency project that's captured the attention of millions worldwide. We're going to explore its intricacies and understand what makes it tick, and the buzz around Banxa's $19 million liquidity injection. This is a significant event, a substantial investment that has the potential to reshape the Pi Network's landscape. It's a move that has everyone talking, wondering about its implications and the future of Pi. Banxa, a major crypto on-ramp, a well-established and respected player in the cryptocurrency exchange arena. They facilitate the seamless conversion between traditional fiat currencies and digital assets, making crypto more accessible to the masses. Just poured serious money into Pi's ecosystem, injecting a substantial amount of capital into the network. This investment is intended to bolster the network's liquidity and facilitate smoother transactions for its users. Usually that's the kind of news that sends prices soaring. A large influx of capital typically creates upward pressure on the price of an asset, as increased demand often leads to a price surge. This is a common expectation in the crypto market. But this time, things didn't quite go as expected. Pi's price barely moved, remaining relatively stable despite the significant investment, leaving the community puzzled, scratching their heads and wondering why the expected price surge didn't materialize. Why didn't this massive liquidity boost trigger a price surge? What factors are at play that prevented the usual market reaction? This isn't just a headline, it's a complex situation that requires deeper analysis. It's a lesson in how crypto markets really work. It highlights the nuances and complexities of the crypto world, demonstrating that market behavior isn't always predictable. We'll break down what liquidity means, exploring its importance in maintaining a healthy and efficient market, why Banxa's move didn't spark a rally, delving into the specific reasons why this particular investment didn't have the anticipated effect, and what it reveals about Pi's unique challenges. We'll examine the specific hurdles and obstacles that the Pi network faces in its quest for widespread adoption and value appreciation. We'll also look at what needs to happen for Pi's value to rise, identifying the key factors and catalysts that could potentially drive its price upward in the future, and what this means for you as an investor. We'll provide insights and analysis to help you make informed decisions about your potential involvement with the Pi network. Ready to get to the bottom of the $19 million question? Are you prepared to unravel the mystery behind this unexpected market reaction? Let's get started. We'll begin our analysis by exploring the fundamentals of liquidity and its role in the cryptocurrency market. Before we dive deeper into the nuances of market reactions, it's crucial to establish a solid understanding of a fundamental concept: liquidity. So, let's clarify what liquidity even means in the context of crypto assets. It's a term you'll hear often, and grasping its implications is key to navigating the crypto landscape effectively. At its core, liquidity refers to how easily you can buy or sell an asset without significantly impacting its price. Think of it as the market's ability to absorb large orders without causing drastic fluctuations. In simpler terms, liquidity is how easily you can convert an asset into cash or vice versa without causing big price swings. A highly liquid asset can be bought or sold quickly and efficiently, with minimal price disruption. In the crypto world, high liquidity means you can execute trades quickly and at relatively stable prices. This is essential for traders and investors who want to enter or exit positions without incurring significant losses due to price slippage. Conversely, low liquidity means that even relatively small trades can move the market substantially, leading to increased volatility and potential losses. Imagine trying to sell a large amount of a token with low liquidity. You might have to lower your price significantly to find buyers. So when a company like Banxa adds liquidity to a cryptocurrency, they're essentially making it easier and more efficient for people to trade Pi. This increased liquidity helps to prevent wild price changes, creating a more stable and predictable trading environment. This injection of liquidity is usually accomplished by funding liquidity pools. These pools are essentially reserves of Pi and stablecoins held on exchanges, allowing for smoother and more efficient trading. They act as a buffer, absorbing buy and sell orders without causing significant price fluctuations. Ultimately, more liquidity translates to less slippage, the difference between the expected price of a trade and the actual price, and fosters greater trust and confidence in the market. It's a sign of maturity and stability for a cryptocurrency, indicating a healthy and well-functioning market. It represents more than just a simple cash injection. It's about building a robust and reliable trading ecosystem. That's precisely why liquidity events are usually met with celebration and optimism within the crypto community, because they contribute to making trading smoother, safer, and more accessible for everyone involved. However, it's important to remember that liquidity alone doesn't guarantee price growth or upward momentum. So, with this understanding of liquidity in mind, the question remains, why didn't PI's price react more significantly to this liquidity event? That's what we'll explore next. Let's break down Banxa's $19 million move. Banxa is a fiat-to-crypto gateway, helping people buy and sell crypto with regular money. Their investment wasn't a simple purchase. It was about building liquidity pools for Pi and stablecoins. This makes trading Pi more efficient and less volatile. For Banxa, it's a strategic bet. If Pi takes off, they'll be the go-to provider for cashing in and out. Think of it as building roads for a city, necessary for growth, but it doesn't instantly raise property values. Banxa's move is about infrastructure, not speculation. It's a long-term play, laying the groundwork for future adoption. The money deepens the market but doesn't create new demand overnight. That's why the price stayed flat. So, what's really holding Pi back? The launch of Pi Network's Open Mainnet was highly anticipated, with many expecting a significant price surge. However, despite the big news and the excitement surrounding the event, Pi's price didn't budge significantly, remaining relatively stable. This might seem counterintuitive, so let's explore the reasons behind this lack of immediate price movement. We'll break down the key factors that contributed to this outcome, offering insights into the dynamics at play within the Pi Network ecosystem. One crucial element is the addition of liquidity to the market. Adding liquidity stabilizes trading, providing a buffer against extreme price swings. This is because a larger pool of available assets allows for smoother transactions and reduces the impact of individual buy or sell orders. However, it's important to understand that simply adding liquidity doesn't automatically create new buyers or generate increased demand. Liquidity facilitates trading, but it doesn't inherently drive up the price of an asset. A significant factor influencing Pi's price is that it is still in its enclosed mainnet phase. This means that the network operates within a restricted environment, limiting its accessibility to the broader cryptocurrency market. As a result of this enclosed phase, Pi can't be freely traded on major exchanges like Binance or Coinbase. This lack of exchange listings significantly restricts the potential for price discovery and wider market participation. Consequently, the pool of potential buyers for Pi is currently quite tiny. The limited access restricts the number of individuals who can actively participate in the market, impacting the overall demand. On the other hand, there are millions of users who have been mining Pi and are potentially waiting to sell their accumulated holdings. This creates an imbalance between potential buyers and sellers. This creates huge sell pressure in the market, as a large number of users are eager to convert their mined Pi into other assets. Therefore, any price bump, even a small one, is quickly absorbed by people eager to cash out and realize some value from their Pi holdings. This immediate selling pressure prevents any sustained upward momentum. In this context, Banxa's liquidity acted as a shock absorber, mitigating the potential for extreme price fluctuations. The liquidity provision was successful in preventing significant volatility, maintaining a relatively stable price environment rather than fueling a dramatic price rally. It served to dampen the impact of the existing sell pressure. Essentially, the market is currently balanced, albeit at a lower price point than some might have anticipated. The new liquidity introduced into the system is effectively meeting the pent-up selling pressure from miners, resulting in steady price action and preventing a significant price decline. So instead of a price spike that many were hoping for, we observed stability, a testament to the effectiveness of the liquidity provision in the face of considerable selling pressure. In short, the underlying infrastructure for Pi Network is now in place and ready to support trading and transactions. However, the demand from external buyers simply isn't there yet to drive a significant price increase. The market is waiting for broader participation. Until Pi fully opens up to the wider cryptocurrency market, allowing for unrestricted trading and exchange listings, price action is likely to remain muted and constrained by the current supply-demand dynamics. The liquidity provision successfully fulfilled its primary objective, just not the specific outcome that some speculators and investors were hoping for in terms of a rapid price appreciation. So if liquidity isn't the sole driver of price, what else is holding Pi back from experiencing a more substantial increase in value? Let's dig deeper into the underlying factors and explore the other challenges and opportunities facing Pi Network as it transitions towards a more open and accessible ecosystem. Several big factors are keeping Pi's price in check. The enclosed mainnet restricts trading to a closed ecosystem. No major exchange listings, no external wallets. The total supply of Pi isn't fixed, making investors wary of endless inflation. Years of slow development have led to skepticism and fatigue in the community. Most importantly, Pi still lacks a killer use case. There's no must-have app or service driving real demand. Without clear utility and transparent tokenomics, serious investors stay on the sidelines. Until these issues are addressed, Pi's price will likely remain stagnant. So, what could actually change the game? What would finally spark real growth for Pi? The biggest catalyst would be launching the open mainnet, allowing Pi to trade freely on major exchanges. This would open the doors to global investors and real market demand. Clear, transparent tokenomics, especially a fixed or predictable supply, would boost investor confidence. Real-world utility is crucial. Pi needs apps, services, and partnerships that make it genuinely useful. Imagine using Pi to shop online, pay for services, or access exclusive content. Strategic partnerships with established businesses could drive adoption and legitimacy. The Banxa deal built the roads. Now Pi needs traffic, real users, and real use cases. Only then will demand and price have a chance to grow. Until then, patience is key. The Pi Banxa story is a lesson for every crypto investor. Liquidity doesn't equal instant profits. Liquidity creates stability and trust, not price spikes. Always ask, is this money building infrastructure or creating demand? For projects with huge supply and lots of sellers, new liquidity just absorbs sell pressure. Context matters. Tokenomics, community sentiment, and project stage all shape the impact. Don't let big numbers or flashy headlines cloud your judgment. Look at fundamentals, technology, team, roadmap, and real-world use. Liquidity is just one piece of the puzzle. Smart investing means seeing the whole picture. If you've been mining Pi, what should you do now? Manage your expectations. Overnight riches are unlikely. The Banxa event shows that even big money doesn't guarantee a price jump. Treat your Pi as a high-risk, long-term bet, not a sure thing. Never invest more than you can afford to lose, especially in unofficial markets. If you only mined Pi, your risk is just your time. Hold if you believe in Pi's vision and the team's ability to deliver. If you're skeptical or tired of waiting, it's okay to mentally write it off. Stay informed, avoid hype, and be patient. The real test will come when Pi finally hits the open market. To sum up, Banxa's $19 million liquidity move was about stability, not speculation. The price didn't jump because the market absorbed the new liquidity. There's still too much supply and not enough demand. For investors, the lesson is to look past headlines and understand what's really happening. Fundamentals like utility, tokenomics, and open access matter more than flashy numbers. The real catalysts to watch are the open mainnet launch and clear tokenomics. Until then, Pi's price will likely stay flat. Pi is still an experiment. Huge community,